For years, hundreds of millions of ounces of silver quietly disappeared from global inventories, yet the price barely seemed to notice. That disconnect confused many observers. How could a metal with shrinking supply and rising demand remain so subdued? Recently, that silence broke. Silver surged past the $60 level per ounce, with reports suggesting prices briefly exceeded $64, a level some analysts now describe as unprecedented in modern market history. To many, this looks like the move already happened. But according to a growing number of experts, this may only be the beginning. Several major financial institutions have acknowledged what appears to be a confirmed breakout pattern. Near-term price targets in the mid-$60 range are being discussed openly, with projections extending much higher. Commodity analyst Lawrence Leopard, a widely followed voice in hard asset investing, has publicly suggested silver could approach the $75 area by mid-2026. Others have gone further, raising the possibility of prices eventually testing triple digits. These claims aren't based on hype or speculative frenzy. They're rooted in historical patterns, inventory data, and supply-demand mathematics. This discussion isn't financial advice. It's educational analysis built from publicly available information. No affiliations, no endorsements, just pattern recognition. And patterns matter, especially in commodities. Throughout history, when currencies are diluted, when industrial demand accelerates faster than production, and when above-ground inventories fall toward critical thresholds, precious metals don't rise slowly. They reprice violently. The move often appears sudden, but the groundwork is laid years in advance. What we may be witnessing now is the final phase of such a cycle. Many assume central banks can always step in to stabilize markets. Others believe technological innovation will effortlessly solve material shortages. But both assumptions overlook a basic reality. Physical resources obey math, not narratives. Supply deficits compound quietly until the system can no longer absorb them. At that point, price becomes the release valve. Market historians often describe commodity supercycles as unfolding in 4 stages: setup, expansion, strain, and repricing. Silver, according to those who study its history closely, has followed this script multiple times over the past 50 years. The claim now circulating is that we are approaching, or already entering the final stage. To understand why, it helps to look backward. In the late 1970s, silver traded at levels that seemed stable and unremarkable. Global production was stagnant, while industrial usage continued to rise. 2 wealthy investors noticed the imbalance and began accumulating physical silver in futures contracts. As inventories tightened, prices climbed steadily. Then, suddenly, in less than a year, silver multiplied several times over, shocking the market. Although regulatory changes eventually forced prices lower, the underlying shortage at the time was real. The spike wasn't accidental. It was the result of scarcity colliding with demand. That lesson matters today, because when supply gaps are genuine, price suppression doesn't eliminate them. It delays the adjustment, and delays tend to make the eventual move more extreme. The silver market has gone through this process before, and each time the sequence has been remarkably consistent. When demand grows faster than supply and inventories quietly erode, prices often remain muted, until they don't. History shows that silver tends to move in long periods of compression followed by short, explosive repricing events. After the dramatic spike of 1980, silver entered a long dormancy. For much of the 1980s and early 1990s, it traded at relatively low levels, dismissed as an underperforming asset. But beneath the surface, the structure of the market was slowly changing. By the mid to late 1990s, a new demand engine emerged: technology. The rise of personal computers, mobile phones, digital cameras, and early internet infrastructure dramatically increased silver usage. Silver paste became essential for circuit boards, connectors, switches, and electronic components. Between roughly 1995 and 2000, analysts estimated that silver demand from electronics alone increased by around 40%. Yet mine production showed little response. The reason was structural. Unlike gold, silver is rarely mined on its own. Roughly 2/3 of global silver production comes as a byproduct of copper, lead, and zinc mining. If those base metals aren't profitable, silver supply doesn't rise, even if silver demand does. As a result, while consumption surged, output remained relatively flat. By the late 1990s, the imbalance became visible in inventory data. Industry reports indicated that above ground, silver stocks fell sharply, declining from roughly 350 million ounces to near 200 million ounces within just a few years. Prices responded slowly at first, rising from the $4 range into the mid-single digits. It wasn't dramatic, but it was persistent. Then came the 2008 financial crisis. As confidence in financial institutions collapsed, investors rushed toward tangible assets. Silver, already constrained by years of undersupply, reacted sharply. Prices surged past $20 per ounce as the market finally acknowledged the accumulated deficit. Once again, silver didn't rise because of speculation alone. It rose because years of imbalance were suddenly priced in. Fast forward to the most recent cycle. In 2020, global supply chains fractured. Mine shutdowns, labor disruptions, and logistical bottlenecks reduced silver production significantly from prior peaks. At the same time, industrial demand entered an entirely new phase. Solar energy, electric vehicles, 5G networks, AI data centers, and advanced medical technologies all rely heavily on silver. According to industry analysts, solar alone now consumes more than 1/5 of annual silver supply, and deployment rates continue to accelerate. Unlike earlier cycles, this demand is structural, not discretionary. From 2021 through 2025, the silver market reportedly ran consecutive annual deficits, not marginal ones, but large shortfalls. Some estimates suggest the 2024 deficit alone exceeded 250 million ounces, potentially the largest on record. As a result, inventories continued to shrink. Prices followed. Silver climbed from the high teens in the late 2010s to above $60 within a few years, a gain of more than 200%. 3 major cycles, 3 periods of scarcity, 3 powerful repricings. The pattern remains intact, and that brings us to the present moment, where the strain phase may be giving way to something far more volatile. As of late 2025, multiple indicators suggest the silver market is moving beyond simple tightness and toward genuine structural stress. Inventory data, leasing activity, trade flows, and premiums are all signaling the same message. Physical silver is becoming harder to secure. Reports indicate that COMEX registered inventories have declined sharply, falling from levels near 400 million ounces just a few years ago to well under 300 million ounces today. At the same time, policy shifts are adding pressure. China, one of the world's largest producers and consumers of silver, has announced plans to restrict exports beginning in 2026. The rationale is straightforward. Domestic solar expansion, electrification projects, and infrastructure upgrades require enormous quantities of silver. Keeping supply at home reduces dependence on global markets, but it also removes a major source of metal from international circulation. Financial flows are responding. Silver-backed exchange-traded products have reportedly seen large inflows, with hundreds of tons added in a matter of weeks. These vehicles, which require physical metal to back new shares, effectively pull silver out of the available supply pool. As inventories shrink, borrowing physical silver has become more expensive. Lease rates have spiked, reflecting a growing reluctance among holders to part with their metal. Monetary conditions are reinforcing the trend. The Federal Reserve has begun easing policy, cutting interest rates, and signaling a willingness to inject liquidity if economic conditions weaken. Historically, falling real yields in a softer currency environment support precious metals. Silver, however, sits in a unique position. It responds, not only to monetary debasement, but also to industrial scarcity. This dual role is what differentiates the current cycle from previous spikes. In 1980, silver demand was heavily influenced by investment and photography, a sector that later disappeared. In 2011, much of the price action was driven by post-crisis speculation. Today, demand is embedded in technologies that form the backbone of modern infrastructure. Solar panels require silver for conductive paste. Electric vehicles rely on silver-rich electrical systems. AI data centers consume massive amounts of high-efficiency power hardware. Medical devices depend on silver's antibacterial properties. These industries aren't shrinking, they're scaling globally. Supply, on the other hand, remains constrained. Because most silver is produced as a byproduct, higher prices don't immediately translate into higher output. Even new primary silver projects face long timelines, often requiring 7 to 10 years from discovery to production. That lag means deficits can persist far longer than many expect. Substitution is often mentioned as a solution, but silver's unique properties make large-scale replacement difficult. It has the highest electrical and thermal conductivity of any metal and plays critical roles that alternatives struggle to match economically. While manufacturers may reduce usage per unit, total demand can still rise as deployment accelerates. Recycling helps, but only to a point. Much of silver is used in small, dispersed quantities and remains locked in products for decades. Solar panels installed in the early 2010s are only now approaching end of life. Recycling growth is gradual, while demand growth has been rapid. When physical shortages emerge, paper markets lose influence. Futures contracts don't power factories. Metal does. History shows that when industrial buyers begin competing for limited supply, price controls fail, and volatility increases sharply. And that sets the stage for what may come next. With inventories tightening and demand remaining resilient, the obvious question becomes, where could silver realistically go from here? While no one can predict prices with certainty, several analysts and institutions have outlined scenarios based on historical behavior and current supply dynamics. In the near term, some forecasts place silver in the mid to high $60 range as early as the first quarter of 2026. This assumes continued ETF inflows, sustained industrial demand, and the implementation of China's export restrictions. If physical tightness worsens, industrial users may attempt to secure long-term supply regardless of price, amplifying upward pressure. Technical analysts note that once silver decisively clears the upper 60s, chart resistance becomes relatively thin until the $70-$75 region. By mid-2026, more aggressive projections come into play. Estimates around $75 per ounce are based on the assumption that another large annual deficit materializes, potentially reducing global inventories to levels that represent only a few weeks of consumption. Historically, when commodity stocks fall that low, markets can destabilize. Prices don't rise smoothly, they gap higher, with sudden double-digit moves becoming more common. Looking further out, late 2026 scenarios range widely. If solar deployment, electrification, and data infrastructure expansion continue at current rates, some models suggest total silver demand could approach supply limits with little margin for disruption. In such an environment, even minor supply interruptions could trigger outsized price responses. As a result, certain analysts have discussed targets near $100, while more extreme projections speculate even higher if momentum accelerates. Whether those levels are reached or not, the asymmetry is what draws attention. Some observers argue that downside risk may be limited to moderate pullbacks if deficits persist, while upside potential remains significant if the market enters a true supply crisis. That imbalance is what many describe as an unusually favorable risk-reward setup. Investors typically consider several ways to engage with this thesis. Physical silver offers direct ownership without counterparty exposure, though it involves storage and liquidity considerations. Exchange-traded products provide convenience and accessibility, but introduce reliance on financial intermediaries. Mining equities can amplify gains when prices rise, but they also carry operational, political, and cost risks. Each approach has trade-offs, and none are without uncertainty. Of course, doing nothing is also a choice. It assumes that supply will somehow expand rapidly, that demand will slow meaningfully, or that technology will eliminate the need for silver altogether. History suggests those outcomes are less common than expected, especially when deficits have already persisted for years. Short-term volatility should be expected. Silver has always been prone to sharp pullbacks that test conviction. Past cycles show that these declines often convince observers the move is over, just before the next leg higher begins. Structural conditions, not daily price action, tend to determine long-term outcomes. For thousands of years, silver has functioned as money, a store of value and an industrial necessity. Across civilizations, periods of monetary expansion and resource scarcity have repeatedly driven dramatic repricings. The names and technologies change, but the underlying behavior does not. This analysis is not a prediction or a recommendation. It is an examination of patterns, data, and historical precedent. Whether this cycle follows the same path as those before it remains to be seen. But if the breakout underway reflects genuine scarcity rather than speculation, then the most important moves may still lie ahead. And if history is any guide, these moments rarely announce themselves loudly. They reveal themselves to those paying attention.